AI-driven equities are surging even as oil flirts with triple-digit prices and bond yields retest their highs. This tension between growth optimism and stagflation risk is front and center for allocators today. Welcome to vTalkInsight, Allocators Lens Daily for April 29, 2026. In equities, the core story is a powerful but narrow advance led by technology and consumer-facing growth, sitting on top of rising macro risks. Since March, information technology is up roughly 24.5%, communication services nearly 19.5%, and consumer discretionary about 14%, lifting the S&P 500 around 13% off its recent lows. That performance is underpinned by very strong earnings in a small group of large technology firms. Consensus now looks for about 18 to 19% earnings growth in areas tied to artificial intelligence, defense, and energy security, with major U.S. semiconductor earnings expected to surge close to 88% this year, as AI-related capital expenditure pushes ahead regardless of the broader economic cycle. Semiconductors have become the market's fulcrum. They now make up roughly 14% of the S&P 500, double their share at the early 2000s tech peak, and have driven much of the recent margin expansion as sector margins climb from about 30% to 44%. At the same time, many of these stocks recently traded around 40% above their 200-day moving average, levels that have historically coincided with overbought conditions. The first real test of that enthusiasm is coming through the AI complex itself. Reports of slower user growth and missed internal revenue targets at OpenAI, alongside an ongoing governance trial and uncertainty over its listing plans, have triggered sharp pullbacks in AI-linked names such as Oracle, NVIDIA, Broadcom, and AMD, and raise questions about how durable the current AI momentum really is. Competitive dynamics are also shifting. ChatGPT's market share has fallen significantly as rivals like Gemini and Anthropic gain traction, reducing dependence on any single platform. That makes the broader AI ecosystem less vulnerable to one company's missteps, even as the market reacts aggressively to negative headlines and missed targets. Options markets are now pricing elevated earnings risk, with a large portion of index market cap reporting this week and correlations at historic lows. That combination of high dispersion and heavy leverage positioning among hedge funds means disappointments in a few crowded AI or semiconductor names could translate quickly into volatility and moderate pullbacks at the index level. Against that micro backdrop, the macro picture is turning less friendly. U.S. equities remain resilient even as bond yields retest their highs and oil prices surge, effectively acting as a tax on consumers. There's a growing concern that the market may be underestimating the drag from higher energy costs on consumer spending and overestimating the ability of AI capex alone to carry earnings growth. For a cross-asset allocator, this leaves equities finely balanced. The AI and semiconductor boom, reinforced by strong results from names like Seagate and constructive views on Micron, still offers a powerful structural growth story. But concentration, stretched technicals, and AI-specific setbacks are raising the odds of sharper swings. Watch how this week's earnings, energy prices, and any move in long-term yields toward previously flagged stress levels interact with low headline volatility, because that is where the equity-bond disconnect is most likely to resolve. Turning to rates, bond markets are reinforcing a higher-for-longer narrative. Yields in the U.S. and Europe are retesting their highs for the year as markets price stronger growth, persistent inflation, and the possibility that central banks may need to lean more hawkish if current trends persist. In the U.S., long-dated Treasury yields are seen as still too low relative to fundamentals, with term, inflation, and growth premia expected to push the 10-year higher over time. Commentary highlights that a sustained move above roughly 4.6 to 4.75% on the 10-year could become a meaningful headwind for equities, even though that threshold has not yet been reached. The Federal Reserve is widely expected to keep policy rates unchanged for the rest of the year, with even dovish voices adopting a wait-and-see stance as inflation remains above target. There is talk that upcoming communications could downplay the explicit 2% target, reflecting pressure from tariffs and energy, while future leadership, potentially including Kevin Warsh, emphasizes inflation risks, full employment, and a gradual reduction in the balance sheet. Globally, the Bank of Japan is edging toward normalization after holding rates in a split decision and sharply raising its inflation forecast. Japanese government bond yields are expected to drift toward around 1.25% to 1.5% if geopolitical risks ease, even as Japanese yields already exceed treasuries in some maturities, and yet demand for U.S. paper remains solid. For allocators, the key in rates is how this mix of oil-driven inflation, persistent fiscal deficits, and cautious central banks feeds into long-end yields and, by extension, equity and credit risk premia. Credit looks calm on the surface, but is seeing more stress beneath, especially in private markets and lower-income households. In private credit, high-profile losses have pushed investors to reassess risk, with loss expectations moving from near zero to around 8 to 12% and growing concern over stale valuations and limited transparency. Pressure is particularly acute in software-focused business development company loans originated during the low-rate period of 2021 and 2022, where high leverage and peak valuations leave little cushion. Liquidity mismatches are emerging in semi-liquid retail products, as redemption requests meet inherently illiquid underlying loans, making the whole private market cycle highly sensitive to the Fed's tone on future easing. At the same time, institutional inflows into private credit remain resilient, and opportunities are appearing in restructured loans, secondaries, and infrastructure as stressed assets change hands. Investment-grade private credit, particularly for insurance balance sheets, continues to hold up well, and cases like Ares Management show rising unrealized losses but still stable dividends, suggesting stress is concentrated rather than systemic for now. On the consumer side, auto loan delinquencies and charge-offs have climbed back to pre-crisis levels, with an estimated 30% of cars now worth less than the outstanding loan balance. Lower-income households are increasingly relying on wage access loans and pawn shops, and tax refunds are not being used to reduce those balances, pointing to financial fragility that is not yet fully visible in headline spending data and leaving regional and smaller banks more exposed even as large banks continue to generate solid profits. In foreign exchange, policy divergence and energy exposure remain the main drivers. Renewed focus on U.S. exceptionalism, with relatively stronger equity performance and a perception that the U.S. is better insulated from the energy shock, is helping to keep the dollar firm, especially while the Fed leans toward a prolonged pause rather than an imminent cutting cycle. The yen sits at the center of this divergence. The Bank of Japan's decision to hold rates, paired with slightly less hawkish messaging, initially weakened the currency, but the narrow vote and upgraded inflation forecasts signal a rising risk of a rate hike by mid-year as Japan grapples with stagflation-type conditions of weaker growth and higher prices. That mix keeps yen volatility and global carry trades firmly in focus. The pound has shown surprising resilience despite political instability and sharply higher gilt yields, which have risen about 60 basis points since Middle East tensions escalated. However, upcoming elections, questions over fiscal headroom, and elevated energy and financing costs could eventually weigh on both the currency and corporate investment plans, making UK exposures particularly sensitive to any further deterioration in growth or policy credibility. Commodities, and oil in particular, remain the macro hinge for this whole cross-asset picture. Brent crude has pushed above $110 per barrel after rising for 7 straight days, with naval blockades and disruptions around the Strait of Hormuz driving Persian Gulf oil flows down to only about 5% of normal levels and lifting inflation fears worldwide. Geopolitics are adding fuel to that tightness. The UAE's decision to leave OPEC, while producing around 3.5 million barrels per day and targeting 5 million by 2027, sent prices up roughly 4% on the news and underscored the risk that cartel cohesion weakens just as markets are already undersupplied. In the longer run, normalization could trigger a market share battle and more volatile output. Inventories are projected to fall below historic lows even if disruptions start to ease, raising the risk of visible shortages and more volatile physical pricing. Strategic reserve releases are increasingly seen as necessary to manage U.S. drawdowns, with crude and refined product exports running at full capacity and domestic stocks sharply lower, all while Washington rules out export bans and instead leans on measures like blending waivers and shipping rule adjustments to maximize refinery throughput. On the demand side, early signs of strain are already visible. Jet fuel and petrochemical consumption, particularly in Asia, is being cut back as higher prices bite, and some chemical supply chains report only a couple of months of inventory remaining, implying potential production curtailments if shipping routes and feedstock flows are not restored soon. For Europe and parts of Asia, sustained high oil and gas prices increasingly resemble a stagflation shock with rising recession risk. Even in the U.S., where refinery capacity exceeds domestic demand and exports help keep a lid on local prices, higher gasoline and utility bills function as a tax on households. When combined with heavy AI infrastructure spending, which is energy-intensive and adds to nominal demand, the result is likely higher nominal growth with a larger share coming from inflation rather than real expansion. For allocators, the key is whether energy markets stabilize before that stagflationary impulse forces a more decisive response from central banks. Stepping back across assets, an AI-led and semiconductor-heavy equity market is riding strong earnings and capex, even as higher oil prices and rising yields push the macro narrative towards slower real growth and stickier inflation. Rates are settling into a higher-for-longer regime. Private and consumer credit are starting to show more strain beneath tight public spreads. Currencies are expressing policy divergence, and commodities, led by crude, remain the critical swing factor for both inflation and growth scenarios. Over the coming days, watch how this week's earnings, long-term yields, energy headlines, and election rhetoric interact, because that is likely to determine whether the current disconnect between risk assets and macro risks narrows gently or through sharper repricing. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.